Welcome to the What If Lab. What would happen if the stock market crashed? What would our world look like? At this moment, the global market is experiencing severe turbulence. In April 2025, U.S. President Donald Trump announced a 34% punitive tariff on Chinese imports and implemented a selective tariff policy on other countries, including Taiwan. The market grew concerned about the potential restart of a global trade war, leading to a 4-day consecutive plunge in the U.S. stock market, with a market value evaporating by over $4 trillion. Taiwan also faced a market storm after the Qingming Festival holiday. On April 7th, the stock market opened with a crash of more than 2,000 points, setting a record for the largest single-day intraday drop in history. Over 1,700 stocks hit the daily limit down, with TSMC also dropping to the limit, causing a daily market value loss of over 2 trillion NTD, and a total market value loss of more than 6.6 trillion NTD. But this is not the first time. Looking back through history, we've witnessed such sharp drops, panic, and consequences multiple times. In this video, let's explore the question: if the stock market really crashes, what would my life, our country, and the entire world look like? Together, we will step-by-step deconstruct this hypothetical scenario through history, data, economic models, and real-world cases. If the stock market truly crashes, how will we face it? A market crash is never just a market issue. It's a breakdown in the mechanisms of human trust. It's the economic system revealing its own contradictions. There have been 3 landmark crashes in history that forced the world to rethink the cost of capitalism. In October 1929, the New York Stock Exchange saw a wave of panic selling. On October 24th, Black Thursday, the Dow fell nearly 10% in a single day. Within the next 5 days, over 13 million shares were dumped, triggering a historic plunge. By 1932, U.S. stock market value had collapsed by nearly 89%. GDP fell by almost 30%, and unemployment soared to 25%. Banks failed. Companies went bankrupt. People lined up for bread, creating the first true image of modern capitalist collapse. Why did a crash cause such total devastation? Because at the time, government and central banks had almost no concept of market intervention. Economist Barry Eichengreen pointed out, the real mistake of 1929 wasn't the crash itself, but the slow and conservative policy response that followed, which amplified the shock. The Fed failed to inject liquidity. Bank failures triggered a credit freeze, and the real economy collapsed for 3 straight years. This disaster taught us a brutal truth. The crash isn't the worst part. The worst part is when governments do nothing afterward. On October 19, 1987, the Dow Jones plunged by 22.6%, the biggest single-day drop in history. This became known as Black Monday, but the panic wasn't limited to the U.S. The UK's FTSE 100, Hong Kong's Hang Seng Index, and Taiwan's weighted index also fell by double digits in just days. The causes were complex: overvaluation, trade deficits, uncertain interest rate policies. But the spark that lit the fire: program trading and index arbitrage spiraling out of control. What made this crash significant was the global realization that financial markets had become deeply interconnected, even without clear signs of a recession. A technical crash could trigger worldwide capital flight. That night, U.S. Federal Reserve Chairman Alan Greenspan issued a key statement: the Federal Reserve stands ready to provide whatever liquidity is necessary to support the economic and financial system. That sentence marked the turning point in market confidence. From then on, central bank commitment became the psychological backbone of global markets. On September 15, 2008, Lehman Brothers collapsed. Before that, the U.S. subprime mortgage market had already piled up trillions in risky financial derivatives. These instruments were mistakenly rated as safe, while hiding large volumes of unpayable debt. When the bubble burst, it wasn't just about falling home prices. It was about the entire financial system losing trust in itself. AIG, Morgan Stanley, Citibank all faced liquidity crises one after another. The Dow fell over 50% from its 2007 peak. The U.S. entered a deep recession. Over $30 trillion of global market value evaporated within a year. Taiwan's exports in Q1 2009 dropped by 44%. The TAIEX index plunged below 4,000. Companies slashed jobs. Youth unemployment soared. But this crisis also marked a turning point in economic policy. The U.S. launched TARP, a $700 billion bailout package for banks. The Fed began quantitative easing QE for the first time in history. Central banks coordinated rate cuts and liquidity lifelines. This crash taught the world free markets can't always heal themselves. When the financial system itself collapses, governments must become the bearer of last resort and lender of last resort. In March 2020, as COVID-19 spread, the global market suffered a super-speed crash. U.S. stock markets triggered circuit breakers for times in 10 days, a first in history. The S&P 500 dropped 34% in less than a month. Oil prices even went negative, something never seen before. This time, the crisis wasn't rooted in finance but in fear. Fear of total lockdown and global paralysis. But what's important here is this. Capital markets react far faster than the real economy. In the same week, the Fed and U.S. Treasury launched QE, unlimited bond buying and direct subsidies to households and businesses. The market quickly bounced back. This sparked a new debate among economists. Has the market become policy-driven? Have we entered a new world where central banks make stock prices invincible? From 1929 to 2020, every major stock market crash has taught us human nature is the biggest market risk. Systemic risks are only visible after the crash. Government action can stop the bleeding, but it can't erase the underlying cycle. Economist Hyman Minsky once proposed the financial instability hypothesis. Stability breeds instability. Long periods of prosperity encourage speculation and excessive leverage. These structural weaknesses are like poorly built buildings in an earthquake. They crumble instantly under stress. In the next chapter, we'll enter a world after the crash, where falling numbers are no longer just on a screen, but real domino effects in the physical world. What happens then? A stock market crash, for many, is just a symbol of asset shrinkage and investment losses. But in economics, it is a social chain reaction. Just like an earthquake triggers a tsunami, a stock market crash will spread along a few clear paths, from the numbers on the screen to our daily lives. When you see your stock account shrinking, what's your first reaction? Save money? Spend less? Wait and see. This is what's known as the reverse wealth effect. Economist Robert Shiller pointed out in the 2000s that rising stock markets increase people's perceived wealth, thereby boosting their willingness to consume and invest. Conversely, a falling stock market makes people hesitant to consume and businesses hesitant to invest, leading to a drop in overall demand. According to research by the Federal Reserve, for every dollar of stock market wealth lost, consumption shrinks by about 2 to 5 cents. This ratio may seem small, but when the global stock market loses $10 trillion in total value, the multiplier effect expands. After the 2008 global financial crisis, U.S. personal consumption expenditures contracted for 4 consecutive quarters, becoming one of the main causes of the recession. The Central Bank of Taiwan pointed out in 2012, stock price declines have a significant impact on elderly and middle-class families, particularly in the consumption of discretionary goods. When you feel that the future is more uncertain, you choose to delay buying a car, not traveling abroad, or not upgrading your phone. This is the first wave of domestic demand contraction, triggered by a stock market crash. What happens when corporate revenues decrease and stock prices plummet? No new hires, reduced capital expenditures, postponed investment plans. When a company's market value crashes, they face reality issues. Financing becomes expensive or difficult. Valuations become unstable, mergers and acquisitions cannot proceed. During the 2008 financial crisis, capital expenditures of major U.S. and European companies shrank by more than 20%, and layoffs spread from Wall Street to Silicon Valley. The automotive industry and the service sector. Taiwan was no different. In the first quarter of 2009, Taiwan's manufacturing industry saw a factory utilization rate drop below 50%, with a GDP contraction of 8.36% in one quarter, the worst record since the financial crisis, according to data from the Directorate General of Budget, Accounting, and Statistics. Taiwan's unemployment rate peaked at 6.13% that year, with youth unemployment exceeding 12%. These numbers are not abstract. They represent thousands of graduates who immediately face unemployment stories. A deeper crisis comes from the financial system itself. When the stock market crashes, many financial institutions' net assets also drop. This leads to banks and insurance companies raising risk management standards, tightening loans, and reducing investments. This directly leads to small and medium-sized enterprises unable to get loans, personal loans and mortgages tightening, a wave of bankruptcies and defaults as cash flow dries up. According to statistics from the Bank for International Settlements (BIS), during the 2008 crisis, global cross-border lending shrank by nearly 40% in 1 year, causing the phenomenon known as credit crunch. The IMF's 2009 report stated, when market confidence collapses, the financial system no longer acts as an intermediary for resource allocation but becomes a bottleneck for economic growth. In simple terms, when the market dies, money stops flowing, and the economy naturally suffocates. In today's world, a stock market crash is never confined to one country. The interconnectedness of global markets makes every financial storm a systemic event that spreads across borders. After Black Monday in 1987, U.S. stocks crashed, and the Hang Seng Index in Hong Kong plummeted more than 30% in 3 days, with the UK's FTSE dropping 22%. After the 2008 financial crisis, stock markets in 20 emerging markets dropped by more than 40%. The IMF and Harvard scholar Kenneth Rogoff warned, in a world of free-flowing capital, confidence is a global currency. Once major markets crash, investors simultaneously pull out of risk assets, leading to capital outflows from emerging markets, sharp exchange rate fluctuations, and a double blow to both stocks and currencies. Now, let's return to our island, Taiwan. The key feature of Taiwan's economic structure is its highly export-oriented nature. Exports account for more than 60% of GDP, with technology and electronic components being the main driving force. And foreign investment in Taiwan's stock market accounts for over 40%. In other words, when the global market crashes, foreign capital pulls out and orders disappear. Taiwan's economy will directly catch a cold or even fall seriously ill. For example, in 2008, Taiwan's exports decreased by 44% in the first quarter of 2009. The new Taiwan dollar depreciated by nearly 8%. The stock market dropped from its peak to nearly 4,000 points, and the unemployment rate hit a new high. And all of this stemmed from the chain reaction caused by the U.S. subprime mortgage bubble. The Taiwan Institute of Economic Research reported, after the global financial crisis, Taiwan's manufacturing and technology sectors were impacted by demand freezes. Capital expenditures plummeted, and the economy reversed course. Moreover, this impact is compounded. Decreased external demand gives reduced exports gives. Corporate losses gives layoffs and wage cuts gives domestic demand weakens. From a certain perspective, Taiwan is a country that eats confidence, and a stock market crash is the biggest killer of confidence. Taiwan is a small, open economy in the global capital and goods circulation system. Our industries rely on external demand. Our stock market depends on foreign capital, and our confidence can easily be blown away by global storms. So, when the stock market crashes, how will Taiwan's dominoes fall? On April 7, 2025, the first trading day after the Qingming Festival holiday, the Taiwanese stock market plunged as expected. The Taiwan-weighted index opened with a drop of 1,144 points, with an intraday loss of up to 2,086 points, closing down 2,065 points, a 9.7% drop. This marked the second largest single-day decline in history, with a market value evaporation of over 6.6 trillion NTD. More than 1,700 stocks hit the daily limit down. TSMC 2,330 hit the limit down to 848 NTD, with a single-day market value loss exceeding 2 trillion NTD. The direct trigger for all of this was the Trump administration's imposition of a 30% import tariff on Taiwanese export products, which instantly erased Taiwan's export competitiveness. The market turned overwhelmingly pessimistic about the prospects of the semiconductor and AI industries. In response to the market panic, the Financial Supervisory Commission implemented 3 urgent measures: reduced the limit on short selling to 3%, raised margin requirements for short selling to 130%, relaxed collateral types to enhance investor funding flexibility. At the same time, the executive yuan launched a new industry response plan worth 88 billion NTD and stated, "We are closely monitoring foreign capital flows and market confidence, and we do not rule out the use of the National Stabilization Fund." Multiple analysts have stated that the crash in Taiwan's stock market reflects not just market panic, but a global reassessment of Taiwan's economic fundamentals. A head of a securities firm's research department bluntly stated, "This is not a simulated stock market disaster. It's a global economic reality stress test for Taiwan." Exports account for more than 60% of Taiwan's GDP, especially in the electronics and technology industries. Among these, semiconductors, components, communications equipment, and panels are the main drivers of Taiwan's exports. The key markets are China, the US, ASEAN, and Europe. This economic structure binds Taiwan's growth closely to the global economic climate. After a global market crash, the loss of capital typically leads to reduced consumer spending, corporate downsizing, and fewer orders. Exports become the first victim. After the 2008 financial crisis, Taiwan's exports fell by more than 20% year-on-year, with information and electronics products declining by nearly a third, according to data from the Directorate General of Budget, Accounting and Statistics. Taiwan's GDP growth rate for the first quarter of 2009 was -8.36%, one of the worst records in history. When the global market stops spending, Taiwan has nothing to earn. This is not a matter of strategic choice, but a structural reality. In addition to exports, another structural risk is the over-reliance on foreign capital in the stock market. According to Taiwan Stock Exchange data, foreign investors once held more than 40% of Taiwan's stock market value, with even higher control over tech stocks. Once global risk appetite drops sharply, these foreign investors will quickly exit emerging markets, shifting their investments to safer assets such as US dollars, government bonds, and gold. The result is stock market crash, currency devaluation, and capital flight. During the 2008 crisis, the new Taiwan dollar fell from 30 to 34 against the US dollar, and the Taiwan stock market dropped below 5,000 points in a week, breaking the 10-year moving average. Foreign investors sold off more than 100 billion new Taiwan dollars in a single week, setting a record for that year. Economist Lin Zujia pointed out, Taiwan's financial market is more open than its risk tolerance, and foreign capital flows in and out create an asymmetric structural pressure. This means, during an upward trend, we benefit from foreign capital accelerating profits, but during a crash, we suffer the consequences of foreign capital pulling out rapidly. When you open the news and see the stock market crashing and companies laying off workers, what do? Most likely, you will delay buying a car, not travel abroad, reduce entertainment expenses, and only buy necessities. This is what is known as the consumption winter, when companies also reduce spending and freeze hiring due to shrinking revenues and asset losses. The entire economy's momentum will freeze both externally and internally. In 2008, Taiwan's unemployment rate rose from 4% to 6.13%, with youth unemployment exceeding 12%. Small and medium-sized enterprises were particularly hard hit. According to statistics from the Small and Medium Enterprise Administration, the number of small businesses that went bankrupt that year reached a 5-year high, with the hardest-hit sectors being electronics, tourism, and restaurants industries linked to intermediate domestic demand, from exports to confidence, from businesses to individuals. The domino effects, triggered by a stock market crash, have almost no blind spots in Taiwan. When the stock market continuously declines, something you often hear in the news but may not fully understand happens. Margin calls. Taiwan has a large number of retail investors using margin financing to buy stocks, meaning they borrow money to invest. When stock prices fall to a certain point, brokerage firms will require them to replenish the margin. If they can't do so, the stocks are automatically sold to stop the loss. This led to a wave of forced sales in 2008, intensifying market selling pressure and causing a technical crash. At the same time, due to foreign capital outflow and falling stock prices, insurance companies, pension funds, and other long-term institutions experienced greater book losses, becoming more conservative in their investment behaviors, and the entire market entered a cycle of liquidity drought. No one dares to buy, only people want to sell. This market situation is called the dysfunctional price signaling mechanism in economics. Stock prices no longer reflect the value of companies, but rather human fears and financial pressure. In this situation, the role of the Taiwanese government becomes crucial. The most important tool is the National Stabilization Fund. This policy fund, established in 2000, is authorized to intervene and purchase stocks during irrational market crash to stabilize market order. The National Stabilization Fund was activated during the 2000 dot-com bubble, the 2008 financial crisis, the 2011 European debt crisis, and the 2022 inflation crisis. In 2008, the National Stabilization Fund intervened with a scale of 50 billion new Taiwan dollars, combined with the three major institutional investors and government-guided buyback mechanisms to form the national team supporting the market. However, as many economists have pointed out, the role of the National Stabilization Fund is to stop the bleeding, not to cure the disease. It can sustain panic but cannot hold up the fundamentals. Other measures include the central bank continuously cutting interest rates 7 times in 2008, a total of 2.375 percentage points, lowering the reserve requirement ratio, releasing liquidity, expanding domestic demand programs, public infrastructure, issuing consumption vouchers, employment stabilization plans, short-term worker subsidies, and small and medium-sized enterprise financing guarantees. These are all safety nets to hold up the economy. But like emergency medical aid, they can only buy time, not cure the underlying cause. Let's return to the initial question. What if one day the U.S. stock market experiences a continuous meltdown due to geopolitical tensions, uncontrollable inflation, or the burst of a tech bubble, leading to a complete withdrawal of capital from emerging markets. Do you think Taiwan will be fine? Export orders cut drastically. Foreign capital sells off for 7 consecutive weeks. The new Taiwan dollar falls to 35 against the US dollar. Unemployment rate surges, youth job seekers fail. Housing prices start to adjust. Stock market drops below 10,000 points. These are not scare tactics, but things that have happened in history. The only difference is this time, are we prepared enough? When the stock market crashes, the drop in indices is just a symptom. What really happens is an elimination race between industries. Some industries collapse almost instantly, while others, like air raid shelters, become the last safe haven for capital. If you are an investor, a business owner, or just a citizen concerned about Taiwan's economy, this chapter is crucial. When the economy weakens, capital tightens, and consumer confidence declines, the first industries to suffer are those that are highly correlated with economic cycles. These industries share several characteristics. Their products or services are considered non-essential spending. They are capital-intensive or highly leveraged. They heavily depend on external demand or global orders. They have weak pricing power and are easily affected by market fluctuations. Representative industries include automotive and shipping, steel and construction materials, electronics manufacturing services (EMS), real estate development. During the 2008 financial crisis, global car sales dropped by over 35%, and the Baltic Dry Index BDI plummeted by 94% in 6 months. Taiwan's shipping, steel, and electronics manufacturing stocks also saw significant losses. For example, China Airlines' stock price dropped by more than 70% in 2008. In the real estate market, real estate agencies often saw zero transactions, and developers halted new projects, leading to a market freeze so cold it was colder than the 7th month of the lunar calendar. In these industries, once cash flow is cut off, companies can easily go bankrupt overnight. The second group of victims are those businesses that live on borrowed money. Leverage can amplify profits when the economy is strong, but during a crash it becomes a fatal wound, because the interest still needs to be paid but the income has disappeared. During the 2008 financial crisis, the default rates of U.S. real estate developers, private equity firms, and high-leverage companies surged. Taiwan also experienced a chain reaction of bankruptcies and broken investments. Highly indebted companies are the first to be excluded from loan lists by banks. When capital markets tighten, even facing cash flow cuts, downgraded credit ratings, and plummeting stock prices. As Harvard University's Carmen Reinhart said, when the bubble bursts, the first to suffer are those with the heaviest leverage. So, what about the tech industry? This is Taiwan's most important industrial pillar, and also the most concentrated target for foreign investment. However, the performance of the tech industry during a stock market crash is a typical high-risk, high-reward structure. After the 2000 dot-com bubble burst, the Nasdaq index dropped by more than 78% in 3 years, and many startups disappeared. Taiwan's optoelectronics, DRAM, motherboard, and IC design stocks saw their market values halved or even wiped out in a year. During the 2008 crisis, tech stocks were hit hardest due to reduced capital expenditures, delayed orders, and worsening economic expectations, turning this industry into a growth market confidence stock casualty. But we cannot overlook the resilience of the tech industry. For example, TSMC's stock price dropped below 40 new Taiwan dollars during the 2008 crash, but after the crisis it quickly recovered, demonstrating strong rebound power, showing that leading companies have remarkable risk resilience. The conclusion is tech stocks are not uninvestable, but you need to look longer and endure deeper. When everything collapses, some industries show remarkable stability. These are called defensive industries, including food and essential consumer goods, for example, Uni-President, PX Mart, public utilities, water, electricity, gas, telecommunications, health care and medical services. High stability, high dividend industry leaders, for example, Chunghwa Telecom, Formosa Plastics. Their characteristics are, even in the worst economic times, people still need to eat, use water, access the internet, and see doctors. In 2008, Uni-President's stock price only fell by a single-digit percentage, much less than the 40% drop in the overall market. Chunghwa Telecom even became the only stock among Taiwan's 50 index components to rise that year. During a crash, these industries not only provide stable revenues, but they also attract capital-seeking refuge, becoming a safe haven for institutional investors. Overall, the industry structure of Taiwan's stock market is concentrated in tech and electronics stocks, which means when the global tech industry faces corrections, Taiwan's stock market will be hit hardest. When foreign capital pulls out, the impact is amplified due to high investment concentration. The lack of a sufficient proportion of defensive industries weakens overall resilience. According to 2024 data, -1 out of the top 10 companies in Taiwan's market capitalization are from the semiconductor or electronics industries, with TSMC accounting for over 30% of Taiwan's total market capitalization. Although this structure has strong growth potential during bull markets, in bear markets it also amplifies overall volatility and crash risks. There is one industry that is invisible yet the easiest to collapse: confidence. Confidence determines whether the capital market functions, whether companies invest, whether consumers spend, and even whether the government can issue bonds or implement policies. When confidence collapses, all industries will suffer, but when confidence stabilizes, even just a little, the entire economy still has hope. This is the ultimate significance of government interventions, central bank statements, media guidance, and each investor choosing to face the market with calm and rationality. The hardest thing to predict in financial markets is not economic data or policy trends, but human nature. When the stock market begins to plummet, there's one thing that no financial news outlet will tell you. The real reason behind the market downturn is actually the loss of control over human behavior. Traditional financial theories assume humans are rational economic agents, Homo economicus, making the best choices based on information and logic. But in reality, investors often make decisions that go against rationality. Nobel laureate Daniel Kahneman, in his research, pointed out, people experience the pain of loss much more intensely than the pleasure of gain. This phenomenon is called loss aversion. So when stock prices fall, people don't calmly analyze the situation. They're driven by emotions, entering a state of panic. This is why every stock market crash is accompanied by so-called panic selling, forced liquidation, contagion effect. When the market drops, the behaviors of institutional investors and retail investors are distinctly different. Institutions usually adjust based on asset allocation, risk tolerance, and automated adjustment mechanisms using hedging tools. Retail investors, on the other hand, are more easily influenced by emotions and often make worse timing decisions. According to statistics from the U.S. investment behavior research organization Dalbar, over the past 30 years, the average annual return for U.S. retail investors was only 3.6%, compared to over 10% for the S&P 500 during the same period. Why is that? Because retail investors often buy at market highs, sell at market lows. Taiwan is no exception. During major stock market drops in 2008, 2011, and 2022, Retail investors typically sold at the tail end of panic selling, missing out on the rebound. This isn't because retail investors are less intelligent, but because during extreme market volatility, the gap between information, confidence, and action becomes quickly magnified. In Taiwan's stock market, there's another unique mechanism that makes crashes even worse: margin calls. According to the Taiwan Stock Exchange, retail investors can operate on margin, borrowing money to buy stocks. The typical margin ratio is 40% equity and 60% borrowed funds. When stock prices drop beyond a certain point, brokers will demand that investors replenish their margin. If they fail to do so, the broker automatically sells the stocks without notifying the investor, a process known as a margin call. This forced selling pressure doesn't just come from individual emotions, it's built into the system itself. In October 2008, Taiwan's stock market dropped over 22% in a single month, with an estimated 10 billion new Taiwan dollars in margin call-induced selling pressure. This created a vicious cycle of the more it falls, the more it sells, distorting stock prices and intensifying the crash. This technical market kill mechanism makes Taiwan's market particularly vulnerable during stock market crashes. Apart from the system design, people's reactions to crashes are also closely tied to how they receive information. In the age of social media, every piece of news, every chart, and every comment can trigger a panic response. Rumors in line groups: the National Stabilization Fund has sold out, and you still haven't sold. Pessimistic analysis on Facebook: the U.S. stock market will crash to 2008 levels. Financial influencers live streaming panic selling: if you don't sell now, it'll be too late. These pieces of information aren't necessarily wrong, but they are extreme. Behavioral finance scholar Robert Shiller once said, "Market panic is often driven by social narratives, rather than reflecting economic data." At the moment of a stock market crash, it's no longer a logical calculation of financial reports, interest rates, or company values. It's a collective psychological disaster. On a personal level, can you avoid checking your phone when the market is plummeting? Can you remain rational when your portfolio is down by 50%? Can you resist following the crowd and instead stick to your original plan? These are the qualities of the few who survive during a stock market crash: disciplined asset allocation, psychological preparation through simulated declines, support from cash reserves and risk management tools, long-term confidence in the market. Otherwise, when the market starts to crash, you'll realize you're not investing, you're gambling on psychological resilience. When the stock market crashes, the economy freezes, and the capital market becomes a battlefield. Many people ask one question: where is the government? This question, when unanswered in 1929, responded to in 1987, became a turning point in 2008, and reached its historical peak in 2020. Let's take a look at whether the government can really intervene when the market crashes. The United States, as the world's largest economic and financial entity, has played the role of the first responder in nearly every stock market disaster. Here are the key policy responses from three critical periods. 1987 Black Monday, the power of confidence statements. On that day, the Dow Jones Industrial Average plummeted 22.6%, and market confidence was on the brink of collapse. The next morning, Federal Reserve Chairman Alan Greenspan issued a brief statement. The Federal Reserve will provide necessary liquidity to maintain market order. This statement, which historian Kenneth Garbade called the turning point in market psychology, calmed the markets. No quantitative easing key. No bailout funds, just a public commitment to support with funds. And the market stabilized. This proved that, in times of panic, sometimes words are more important than actions. 2008 financial crisis, from quantitative easing to nationalized shares. This was the most comprehensive policy intervention experiment in modern history. After the crash, the U.S. government and the Fed launched multiple initiatives. TARP Troubled Asset Relief Program. The Treasury allocated $700 billion to buy bad assets and stocks from financial institutions to avoid systemic collapse. Quantitative easing key. The Fed began QE in late 2008, buying unlimited amounts of U.S. Treasury bonds and MBS mortgage-backed securities to expand the money supply. Interest rate tools. The federal funds rate was cut to near zero to lower borrowing costs. Liquidity tools. Emergency funding channels for financial institutions, such as TALF and CPFF, were established. Financial regulation reform. Stronger capital requirements for banks and the introduction of the Dodd-Frank Act. This series of policies successfully avoided a financial system collapse, and the U.S. stock market entered a 10-year bull market starting in 2009. However, it sparked a debate: is government intervention in the market a necessary evil or a long-term risk? Nobel laureate Joseph Stiglitz criticized TARP. The government saved the banks, but taxpayers bore the wrong costs, and financial elites faced no punishment. 2020 COVID crash. The rapid evolution of policy responses. When the market experienced for circuit breakers in 10 days, the Fed and the White House acted almost simultaneously, initiated unlimited QE, bought corporate bonds, ETFs, and even loans for small and medium-sized enterprises, implemented the largest household cash subsidy and unemployment benefits in history, passed a $2 trillion CARES Act fiscal stimulus package. This crisis created the fastest bear market and the fastest rebound in history, but it also left behind huge aftereffects. Stock market valuations became distorted. The fiscal deficit reached a historic high. Inflationary pressures fully exploded in 2022. Economist Nouriel Roubini warned, "This is a short-term stability achieved through unlimited debt, but the long-term instability cost may not have started yet." Compared to the U.S., Taiwan's policy tools are not as large in scale, but the government has developed a localized market rescue model. Here are the three main types of policy tools used in Taiwan. Capital market intervention tools. National Stabilization Fund, approved by the executive yuan and executed by the Ministry of Finance. This fund intervenes to buy stocks during irrational market crash to stabilize confidence. For major funds buying, this includes the Labor Pension Fund, Postal Savings Fund, Military and Public Servants Fund, and others, which the government can guide into the market. Share buyback system encourages listed companies to buy back their own stocks to support stock prices. Margin requirement, reduction and short selling restrictions, eases credit trading conditions or restricts short selling to slow down the market collapse. Monetary policy tools, central bank interest rate cuts and reserve requirement adjustments. These measures release liquidity into the market, improving liquidity for businesses and individuals. Exchange rate stabilization operations, intervening in the foreign exchange market to avoid sharp currency devaluation and protect foreign investor confidence. Fiscal and industrial policies, public infrastructure and expanding domestic demand plans, issuing consumption vouchers and household subsidies, small and medium enterprise financing guarantee plans, short-term worker subsidies and youth employment programs. During both the 2008 and 2020 crises, the Taiwanese government used these combinations of policies. Although their impact was not as significant as in the U.S., they were still considered rapid, flexible, and stable by the academic community. Do policy interventions actually work? This has been an ongoing debate. The mainstream consensus in economics tends to lean toward short-term effective, long-term limited policies can stabilize market confidence and prevent collapse, but they cannot change the fundamental economy. Diminishing returns on monetary policy, when interest rates have already been lowered to extremely low levels, the effects of QE become less and less. Psychological assurance is more important than funds. The government's stance and actions can alleviate panic more than actual operations. Harvard economist Lawrence Summers pointed out, policies can delay the storm, smooth out the decline, but they cannot eradicate fear. For the government, the most important thing is not saving the market, but appearing when the market needs it most. When the stock market crashes, the news will show central banks, presidents, investors, and entrepreneurs. However, behind all of this lies the most practical question: how do I protect my assets? This chapter does not discuss abstract economics, but rather focuses on concrete methods. It's not about predicting the market, but about preparing for it. The most basic principles of hedging can be summed up in 3 words: don't bet at all. That is, 2. Diversify. Assets should not be concentrated in a single industry, region, or instrument. Maintain liquidity. Always have cash or equivalent assets that can be accessed at any time. Discipline. No matter how much panic or greed sets in, stick to your investment plan and avoid making impulsive decisions. These 3 rules are universally emphasized by global fund managers and financial advisors. To survive, it's not about predicting whether the market will go up or down, but about ensuring that when risk occurs, it won't lead to catastrophic losses. True, sound asset allocation is not about achieving the highest annual return, but about minimizing losses during market crashes and recovering quickly. For instance, in the U.S., according to Vanguard data, during the 2008 financial crisis, a portfolio fully invested in U.S. stocks had a minus 37% annual loss. A balanced portfolio with 60% stocks and 40% bonds lost only minus 20%. This illustrates that allocating portions of your portfolio to bonds, gold, and cash is meant to help you survive until a rebound occurs. Many long-term investors practice rebalancing, which means after a market crash, they buy more stocks, reducing bonds or cash, effectively buying against the market trend. This is not about making extraordinary moves, but about following disciplined strategies. Over the past few stock market crashes, several assets have been recognized for their ability to hedge against risk. Gold. During the 2008 Lehman crisis, gold prices increased despite market turbulence. Although volatile, gold is seen as a final store of value during periods of long-term uncertainty. Taiwan investors can access gold through ETFs, physical gold or digital gold accounts, U.S. Treasury bonds. Considered risk-free assets, U.S. Treasury bonds attract funds during periods of market panic, causing their prices to rise and yields to fall. Taiwan investors can invest in U.S. bonds through bond ETFs such as TLT or global bond funds, Japanese yen and U.S. dollar cash. In times of crisis, safe haven currencies such as the Japanese yen, Swiss franc, and U.S. dollar appreciate. For Taiwanese investors, holding assets denominated in U.S. dollars can partially hedge against the risk of a depreciating new Taiwan dollar. Defensive stocks. High-dividend stocks, for example, Chunghwa Telecom, Uni-President, and low-volatility ETFs, for example, Taiwan high-dividend ETF tend to perform better during market downturns. Stocks in healthcare, food, and public utilities are generally more resilient during market crashes. Inverse ETFs and options. Taiwanese investors can use tools such as Taiwan 50 Inverse ETF or Yuan DAS and P 500 Inverse ETF to hedge in the short term. However, these are more suitable for advanced investors and carry higher risks with long-term holdings. If you were to ask Warren Buffett what he values most during a market crash, he would tell you, cash is opportunity. During a market downturn, only those with sufficient cash can avoid being forced to sell losing positions, have the ability to buy undervalued assets, maintain psychological security to make rational decisions, Financial planners generally recommend at least 3 to 6 months worth of living expenses in cash, and never invest all of your long-term assets in the market. When a market crash occurs, your focus shouldn't be on what can I invest in now, but instead on do I have enough cash to wait for the rebound. Finally, here are 5 of the most common mistakes to avoid during a market crash. Selling stocks in a panic, ignoring the original investment plan. Concentrating your investments in a single industry or asset. Believing in unverified group messages and overtrading. Using high leverage to accelerate losses. Not holding any cash, relying solely on luck to bet on a rebound. Hedging is not about avoiding the crisis, but about ensuring that you can survive and thrive once the crisis is over. We have spent nearly an hour analyzing the hypothetical scenario of a stock market crash, dissecting historical disasters, institutional responses, market panic, government policies, and hedging strategies. But beyond the information, data, and models, perhaps the most important thing for us to reflect on is, what does all of this reveal about who we really are? Do you consider yourself a conservative investor or an aggressive one? Do you buy stocks for retirement, for a house, or for short-term gains? Most people tend to overestimate their tolerance for risk during a bull market. But when the market crashes, portfolios are halved, and unemployment looms, they realize what they thought was an understanding of risk was actually just a self-image, untested by a storm. This is the harsh education every stock market crash brings. You don't invest with your mouth. You invest with your nervous system. A mature society should offer multiple opportunities for value realization education, culture, innovation, and care. But when more and more families stake their futures, children's tuition, and retirement security on their stock portfolios, we've essentially securitized our hopes for the future. This isn't the fault of the capital markets, but rather the direction chosen by the entire system. When education is no longer a tool for upward mobility, when wages can't keep up with inflation, when housing prices are far beyond the reach of young people, when an aging society makes retirement security a personal responsibility, people are left with no choice but to invest because, beyond investing, there are no other options. Is such a system stable? Is it free? Is it fair? From 1987 to 2020, each major policy intervention has proven one thing. The government can prop up the market, but it cannot think for the market. When the U.S. bailed out Wall Street in 2008, many people asked, why should taxpayers pay for the risky bets made by financial elites? After the 2020 massive stimulus, the question shifted to, are we using future debt to sustain current prosperity? Acting during a crisis is a political responsibility, but thinking about institutional reform after the crisis is the true honesty of the system. The market is both a mechanism and a belief system. It maximizes resource allocation efficiency, encourages innovation, and provides profit incentives, but it also exacerbates inequality, encourages speculation, and creates illusions. When the market rises, we believe in freedom and choice. When the market falls, we seek protection from central banks and governments. Do we really believe in the market, or do we just believe in its ability to continue rising? This is a question we cannot answer in financial programs, but it is one we must honestly answer within ourselves. Perhaps the question has never been, will a stock market crash happen? But rather, when it does happen, what kind of people will we be? Will we be out-of-control gamblers or calm gatekeepers? Will we be panic-driven followers, or the few who can hold on to long-term convictions? There is no correct answer, only the cumulative choices we make with each event. As economist Hyman Minsky once said, stability breeds instability, and prosperity breeds crisis. So perhaps a crisis is not just a wake-up call. It is also an opportunity for reform. Perhaps a crash is not just a warning, but an opportunity to rebuild trust. This time, how will you choose? Thank you for joining us on this what-if journey. If you enjoyed this video, please like, share, and subscribe. Also, feel free to share your thoughts in the comments section below. We'll see you next time.